So let me talk a little bit about how we got here and the causes of the crisis, because there's also a lot of discussion about what has caused all these homeowners to be in this situation. Is it their fault? Is it someone else's fault? And I think there's some really important aspects of how the foreclosure crisis arrived that maybe don't get enough attention in the popular press and the media descriptions of the foreclosure situation. The root of the huge growth of subprime mortgage lending and mortgage lending based not so much on the ability of homeowners to repay, but on the value of their properties, gets back to the need of investors to receive high yields on their investments. And fundamentally, you had a bunch of investors who were dissatisfied with the fairly low rates that were available on various kinds of investments and corporate securities, and they discovered mortgage-backed securities. So if you can find homeowners who, in an interest rate environment where an ordinary prime mortgage is available for 6%, are willing to pay 9 or 10% interest, that produces potentially huge yields for investors. And because of that demand, because there was a great deal of investment capital available and limited options for investing that capital, Wall Street sent out the word to the mortgage originators and said, we need loans. We need mortgage loans that we can package into securities and sell to investors and go out there and sell the mortgages. And so here we have the depiction of this appetite to get more high interest rate mortgages, which is what subprime mortgages are, so that they can be converted into securities. And ultimately, that message got to the loan originators and the mortgage brokers, the people at the street level who are going to homeowners and encouraging them frequently to refinance existing mortgages, also working with real estate brokers to encourage people to purchase homes. That led to this need to develop these additional mortgage products. And of course, because the appetite was not only for high interest and high yields, but for a large volume of loans, a bigger mortgage is better than a smaller one. So there was a tremendous incentive not only to get more people to borrow money and use their homes as collateral, but to borrow as much money as possible. Ultimately, we got to a situation in 2005 and 2006 when the continual need to increase the amount of originations led to some practices that we now see in retrospect were pretty crazy, including the rise of the no documentation loans and so forth. So this graphic gives you an illustration of the growth of subprime lending in dollar volume, where it was cruising along at a pretty significant level, almost $200 billion a year. And then something kind of interesting happened in 2002 and 2003. Subprime mortgage lending took off and got to the point where it was more than $600 billion a year. And viewed in terms of the percentage of all mortgages, the same thing happened. Subprime mortgages started to crowd out prime mortgages, FHA mortgages, other kinds of mortgages that were available in the marketplace. Now, this didn't happen because suddenly Americans' credit scores started to decline, right? We didn't have a situation in 2003 where suddenly 10% of American homeowners went from having high credit scores to low credit scores. This didn't happen because suddenly American homeowners decided that they wanted higher interest rate mortgages instead of lower interest rate mortgages, right? What happened in 2003 and 2004 was essentially that a number of investment bankers and underwriters and rating agencies developed products, investment products, that made it possible to take very risky mortgage loans and sell that risk, and sell it in ways that were really not apparent to the people who were buying these investments. And that was done in very complex ways with things called collateralized debt obligations and CDOs squared, and I'm not even going to attempt to explain all that in this presentation. But the point is that this huge growth in subprime lending was driven mostly because there was a need to continue to produce mortgage-backed securities and to keep that industry growing. And some created in this period that made that possible. That because subprime loans have always been understood to be riskier than prime loans, investors were typically a little wary of buying them, but the wizards of Wall Street found ways of repackaging that risk and slicing and dicing it in such a way that this huge increase in subprime lending was able to occur. Now, to illustrate the point another way, that this huge increase wasn't really as much a demand from homeowners as a demand from investors, during the same period of time, if you look at the overall mortgage market and you think about the conventional prime mortgages that people used to buy homes and refinance them, and we also have the FHA product, which is a government-insured, self-funded insured mortgage product designed primarily for first-time home buyers, right? Typically low and moderate income. And that program has been around since the 1930s. Progressively, the FHA program, and to some extent the Veterans Guaranteed Mortgage Program, were pushed out of the market by subprime. So a lot of both first-time buyers and existing homeowners who previously might have gotten a government-insured mortgage, and those are fairly strictly regulated, started to be moved into the subprime sector. And a certain number of people who normally would have gotten a prime mortgage ended up getting a subprime mortgage. There's data on that as well, and particularly at the very end of the subprime boom in 2005, 2006, you saw 40–50% of homeowners, borrowers with subprime loans who had credit scores that would have qualified them for prime loans. So something else was going on other than the inability to access credit.